Welcome to The Explainer. Today, we are diving headfirst into that wild, often chaotic time in the market known as earnings season. Look, for a few weeks, 4 times a year, it's a total flood of information, creating these huge price swings that can either make you a hero or, well, really wreck your portfolio. We're going to break down the rules of this game so you can navigate it with a lot more confidence.
And this right here is the central mystery we need to solve. I mean, this isn't some made-up scenario. It happens all the time. A company will come out and seem to do everything right. They'll announce these record-breaking profits, sales are through the roof, and then bam, the market just punishes them with this massive gut-wrenching drop. It feels totally backward, right? Well, the answer to this puzzle gets to the very heart of what earnings season is all about. And it's a lesson that, in the market, the past is really just a prologue.
Okay, so to make sense of all this, here's our game plan. We're going to walk through these 5 key parts. We'll start with the absolute basics. Then we'll uncover what really gets Wall Street's attention. After that, we'll compare the high-stakes world of traders to the patient game of investors. And we'll wrap it all up with the one single rule that everybody, and I mean everybody, needs to follow.
All right, first things first. Let's just establish the fundamentals. What exactly is this season we keep talking about?
The best way to think about it is like the market's moment of truth. You see, for 3 months straight, you've got analysts and investors running on a mix of speculation, economic news, and a whole lot of educated guesses. But earnings season? That's when the speculation stops and reality hits. It's when these companies are legally required to open up their books and show everybody, you, me, their competitors, exactly how the business is actually doing.
And this whole cycle happens like clockwork 4 times a year, in the weeks right after a business quarter wraps up. The season kind of unofficially kicks off when the big banks, your JP Morgan Chases and Citigroups report their numbers. And because the banks are so plugged into the economy, their results tend to set the whole tone. After that, for the next few weeks, it is just a non-stop fire hose of financial data, with hundreds of companies reporting every single day.
Okay, so now we're getting to the heart of it. We're getting a lot closer to answering that big question from the beginning. Why that profitable company saw its stock totally collapse. The key here is to understand that on earnings night, the market isn't just grading the past. It's not the raw historical numbers that cause those huge stock moves. It's the story those numbers tell about the future.
So, on the night of the report, Wall Street and all its super smart computers are laser-focused on these 3 things. First up is earnings per share, or EPS. That's the bottom line profit. Then there's revenue, the top line sales number. For both of those, it's a simple game of beat, meet, or miss compared to what analysts were expecting. But that third item, forward guidance, that one is the true kingmaker.
And this is the crucial point. Investors and their trading algorithms care way more about what's going to happen next than what just happened. Think of it like driving your car. You spend 99% of your time looking through the windshield at the road ahead, not staring in the rearview mirror, right? A company can have a fantastic last 3 months, but if the CEO gets on the conference call and says, hey, the next 3 months look kind of weak, that stock is going to get punished. The past is history. The stock price is a bet on the future.
This right here, this is the holy grail. The beat and raise is the grand slam of earnings reports. It's the company basically shouting from the rooftops, not only did we have an amazing quarter that crushed everyone's expectations, but we're so confident that we think the future looks even better than we told you before. That powerful 1-2 punch can trigger a massive, sustained rally as all the big money funds start piling in.
Okay, so let's explore the first of 2 very different ways people approach this season. The high-octane, super high-risk path of the active trader. For a trader, an earnings report isn't just a chapter in a long story. It is a single, high-stakes, all-or-nothing event. It's like their Super Bowl that happens 4 times a year, and they're trying to score a massive touchdown.
Now, before we even get into trading strategies, we have to talk about the #1 trap, implied volatility, or IV. Just think of IV as the fear and greed premium. Because everybody knows a stock is probably going to make a huge move after earnings, the price of options, which are basically bets on that move, just skyrockets in the days before the report. It's the market's way of pricing in all that anticipation, and it makes those bets really, really expensive.
And this is where so many people get burned. Let's just walk through it. Say you buy a call option for $5, betting the stock's going to pop. The news comes out, it's a beat and raise, the stock jumps. You totally nailed the direction. But then you check your account, and that $5 option is now worth $3. You lost money. What happened? Well, the moment that uncertain news became a certain fact, all that anticipation just vanishes. The implied volatility collapses. We call it the IV crush, and it wipes out the premium you paid. It's the silent killer of so many earnings trades.
So, knowing all that, traders have a few different plays. Some just take the straight-up gamble, buying calls or puts and just praying for a move so huge it overpowers that IV crush. Others play something called a straddle. They buy both a call and a put. They don't care which way it goes. They just need a massive move, up or down. And then you have the really advanced folks who do the opposite. They sell that expensive volatility to other people, betting the stock's move will be smaller than expected. But let me tell you, that is famously like picking up pennies in front of a steamroller.
All right, let's hit the brakes and shift gears into a completely opposite philosophy, the path of the long-term investor. For an investor, earnings season isn't a casino game. A single report is just one data point in a very, very long story. It's like reading one chapter in a 20-chapter novel. It's important, sure, but it doesn't define the entire book.
And this slide really just lays out the fundamental conflict perfectly. The trader sees a win-or-lose event, and their biggest fear is something technical like IV crush. But for the investor, the goal is long-term wealth. They're digging into the report to see if the core reason they own the company, its competitive edge, its management, its place in the market, is still solid. Their biggest fear isn't a 10% drop overnight. Their biggest fear is finding out that the company just isn't a great business anymore.
So as you can see, the investor's playbook looks totally different. A lot of the time, the best move takes some serious discipline. Just do nothing. If you believe you own a world-class business, one slightly off quarter is just short-term noise. Or even better, a smart investor might use that chaos to their advantage. If a great company drops 15% because of some short-term issue Wall Street is freaking out about, the investor sees that as a sale, a chance to buy more of a great thing at a discount. Or if a stock has already had a huge run, they might just de-risk and sell a little bit before the report to lock in some profits and take the gamble off the table.
Okay, so we've got these two totally different approaches. The trader playing the event, the investor playing the business. But even with all their differences, there is one golden rule, one core idea that applies to absolutely everyone who wades into the chaos of earnings season.
And this story about Innovate Corp just illustrates the point perfectly. Imagine a stock closes at $100. Everybody's expecting great things. The report comes out after the bell, and the headlines look amazing. They beat on profit, they beat on sales, and the stock immediately pops 8% to $108 in after-hours trading. But then, an hour later on the conference call, the CFO says something like, "The next quarter looks a little soft." And that's all it takes. The pop completely reverses, panic kicks in, and by the next morning, that stock opens down 12% at $88. The weak forecast for the future totally wiped out the great results from the past.
And that brings us to the single most important rule, especially if you're going to trade during earnings. You must manage your risk. This number, 1 to 2%, should be the absolute maximum amount of your entire account that you ever risk on one single earnings trade. If you have a $50,000 account, your max loss on a bet should be capped at $500 to $1,000. This is non-negotiable. Earnings are just too unpredictable. This rule is what keeps you in the game long enough to survive.
So look, the crucial takeaway here is that success during earnings season is not about having a crystal ball. It's not about being right all the time, it's about having a plan. Before you even think about placing a trade, you have to know, what am I going to do if this thing gaps up 10%? Where do I take my profits? And more importantly, what will I do if it gaps down 10%? Where do I cut my losses? No questions asked. Your real edge doesn't come from guessing right. It comes from the discipline to follow your plan.
And really, it all comes down to this question. There's no right or wrong answer here, but you have to know which game you're playing. Are you the trader, trying to capture that explosive short-term volatility, trying to catch lightning in a bottle? Or are you the investor, trying to build wealth over years by owning a piece of a great business, trying to own a piece of the sky itself? Figuring out which path you're on isn't just a strategy, it's the key to navigating the beautiful madness of earnings season without getting burned. Thanks for digging into this with us.